what's going on, everybody? Welcome now, Stock Trades. Hope everyone's doing well. All right, so first off, I want to apologize. So I had a live scheduled like a couple minutes ago, but fortunately, as you can see in the comment, I typed in at 11:43. So I do my hair, I put on my gel, right? I go. This is my portable studio. I'm actually in Phoenix now. So this is not my house. And there it was, a big accident. So I had to clean it up. And you know me, I like to put bleach. I'm old school. Yeah, you gotta clean it up. So my dog's not doing well, so it's been pretty hectic with that. But yes, someone said, you know what? This sounds like the Opendoor stock. So so I think that was pretty funny, right? I love you guys. Yeah. What's going on, guys? What's going on? Let me see. Let me look at the comment section. Damn, you're telling me I gotta wait 12 hours? Yeah, my bad. I also messed that one up too. Glad to see you soon. Absolutely. What's going on, William? How can I share my views? Yes, if you want to share your views in this one, we can go ahead and we can put it in the comment section. Or what I can do is I can bring you on so we can have a discussion. I'm going to try to make multiple lives today because I'm kind of behind. I want to make one on Clover Health. I also want to make one on Humana. So there'll be 2 lives after this. I know I'm gunning for a lot, but I'm trying to see. I was going to make one yesterday. So what I can do is open it up once I go ahead and do my analysis, and then we could talk. Because to be quite frankly honest, I haven't done my analysis yet. I'm doing it in real time with you guys, right? So you could see how long this normally would take someone with, I got, it's going to take you longer if you do it on your own, but, just something it'll be good learning for everybody, right? Okay. Yeah, so you could, absolutely. Yes, we could do that. Absolutely. Let me run my analysis. Hey, how are you doing, Patel? What's going on? Okay, I'll look like a new, what? Come on, man. Come on. Do I really? Should I comb my hair back? No. All right. Oh yeah, it's up since you started live stream. Oh, is it really? Is it really up? Maybe it's getting jealous, right? Or let me see here. That's hilarious. All right, let's without further ado, let's get to work here and let's do our due diligence. All right. So first off, there, for folks that are tuning in the first time, it's not the first time I talked about Opendoor. I've expressed some genuine concern about it in the past. For folks that don't know who I am, my name is Albert, of course. Al, I go by Al, founder and CEO of Al Stock Trades, financial platform that has over 2.5 billion outputs of institutionally rated data. I also am passionate about medicine. In fact, I'm in medical school. I have a passion for finance. I've become a multimillionaire because of some things that I've learned about how billionaires do business and how they essentially read financial statements to figure out opportunities. So just a little bit about myself. This is not a YouTube channel that has all the bells and whistles, the editing and the editors. It's just me and my passion for finance and my passion to be able to help people make money on Wall Street. That's pretty much, it's as simple as that. Really nothing else. And I'm just tired of people in the 9-to-5 grind, and I'm just trying to give them a way out. So again, no harsh feelings about Opendoor. I'm gonna analyze it, and then I'm gonna speak. If I see something good, I'll say it. If I see something bad, I'll say it. So there is no emotional connection to stocks. At the end of the day, your goal is to make money. So that's just my little disclaimer for folks that do not know who I am. Okay, so Opendoor. Okay, so as you can see, it's 76 cents right now. In the past 5 days, it's down 1.64, month down 23.92, 6 months down 58.2%, year to date down 52%, so pretty much half. It used to be 170. A year down 62%, 5 years down 93, and 93.8. Now, it pretty much, that is all the analysis about 85% of 90% people in the stock market. That's all they do. They don't go deeper, right? They don't go deeper. So in this video, we're going to go deeper. Okay. So just to very quickly talk about some macro or just large stock markets doing well. Overall, the VIX is down 4.57%. On the past 5 days, it's actually down. In fact, from that negative GDP, it spiked up to 28 and then essentially fell back down. I was expecting, if it's truly that the market was very scared of a recession, it would price it back up. But I think it's already baked in. In fact, this was my technical analysis for the S&P 500. We had a breakout, and it's essentially following kind of like my trend here. I think we're going to go up to 5,600 and then fall back down and then reconsolidate, or we could just move up higher. But I'm thinking we're definitely going to retest this 200-day simple moving average, consolidate, and then shoot back up to old new times highs. I think that's going to extend sometime in the next 3 months, right? What is it? May, June, July, 3 to 4 months. Okay. Big things. Lutnick says trade deal is done. They're just waiting on the big dogs that run the country to agree. Trump offers automakers some relief in 25% tariffs. So obviously we do have a Trump put. Smart money is coming back. Smart money has been buying the dip. Dumb money has sold. Now dumb money is coming back online. Again, people that own more than $100 million, they have to file SEC 13F filings, in which you can basically see institutional ownership. Okay. So there's that. Now let's go ahead and go deeper on Opendoor. I just wanted to give you a little bit macro. I'm going to start kind of from the exterior and go in. Okay. Let's see here. Oh, yeah. It's going to be multiple. I'm going to try. Okay. So so we talked about the VIX. Yes. If it's true, let's look at the day. If it's true that we're scared of the recession, then how is it that when the indicator came up, the market actually finished positive, right? So it shows that the market's resilient, and it's just the stock, the S&P has been beaten down a lot. In fact, if you look at Tesla, even though I don't agree with its fundamentals, but people are pricing in robotics, which I think is definitely true. Since its most down day, it has been recovering. So obviously it's about to break the 200-day. So it's very clear that a lot of negative news was baked into this potential tariff war that's been happening. Now, very quickly for Opendoor, you can see this stock has been trading under its 200-day for quite some time. It had some breakouts where it went from $1 to $5, and it had a couple of those moments. But as of right now, it's far away from the 200-day. So from technical wise, it's not doing so well. So what I'm going to do is we're going to talk about the specific stuff involved with Opendoor. But before we do that, let's actually move to the financial statements here. Just kind of, let's just kind of speed through this and see. I'm just going to see if should I do this or should I do this? Yeah, we'll do this. Okay, so let's zoom in a little bit. So as you can see, we could just go ahead and graph revenues for a sec. If you look at revenues, Opendoor's revenue spiked in 2022, and then they've just been basically cutting. They're about, again, these numbers are in millions, so that's about $5 billion of revenue. They had at one point in 2022, $15.5 billion. Again, by the way, this is our all stock trade stock terminal. We have our own terminal. Again, we're a software company. So just wanted to show you, where we're getting this information. Margins have pretty much dropped in 2022, and then they're trying to stabilize them to 8.4%. I don't know what Zillow is, but I don't know. So, that's something to be interesting to look at. Net income is negative 300. So actually, let's just graph it because pictures say 1,000 words. Let's look at operating margins. Look at operating margins. We're still in the negative. Net income. 2022 was just a terrible year. I know they had a lot of revenue, 15 bill, but they lost about $1.3 billion of net income. So they were definitely unprofitable, cash burn. But now you could see they're trying to get into position to decrease net income. But, they went from negative 275 million to negative 392 million. So that's pretty much pretty much where we're at now with negative 200. Let me see here. So yeah, I appreciate all your input. Definitely drop it in there so we can definitely talk. Again, I don't know a lot about Opendoor, right? I'm just looking at the financials and I'm just thinking out loud. I don't have a script I'm reading off of. So I'm just giving you kind of my overview of what's going on and what are things that I look for before I invest in a company, right? Okay, so I don't see net income stabilizing. I do see it dropping, but it's still better than what it used to be in 2021 and 2022. So there's that. Earnings per share, it's becoming more negative, which makes sense because it's unprofitable. Again, for 2022, they were $2 minus per share. Now they're at least negative 50 cents, but still it's bad. Share wise, you have minimal, somewhat dilutive. We can analyze the percent increase in dilution. Book value per share. This is where it gets interesting. So let's go ahead and graph the book value real quick here. So if we look at the book value, you could see you could just kind of read this up here. In 2021, it went from $3.79, 2022, $1.73, 2023, $1.47, and 2024, $1.02. So right now, currently, if Opendoor were to get liquidated, if Opendoor were to get liquidated right now, and it were to go to bankruptcy, then we would get $1, right? So for folks that don't understand that, book value per share represents the accounting value of shareholders' equity for each share. It's roughly an indicator of what each share might be worth if assets were liquidated. The problem is it is dropping down precipitously. So if it does, let's say, drop another, let's say this was what, a 20% drop, and this was a 40, almost 40. So that's a big drop. So like right now it's trading at, what is it trading at right now? 75 pennies with a low of 72. The question is, if they were able to turn it around, then I would say, let's say if they turn it around next quarter or next year, then this is there could be some value here, but still let's continue to go further. Here's my favorite metric, operating cash flow. Operating cash flow, interestingly, if you go ahead and look at it here, it actually turned positive, and you can see the AI summary analysis. It turned positive in 2020, 2021 it turned negative, 2022 it turned positive, and 2024 it turned negative. This is so important, guys. 2022, it was pretty exciting. They were operating cash flow positive. And then interestingly, they're free cash flow positive as well. So 2022 really sparked a good, I would say, moment. Yeah, they were unprofitable up the butt, but I'm curious to see how the market responded in 2022. Yeah, you see, it was around $20, but then still had some juice in it, but then it slowly started deteriorating. Why? Because that's really interesting. They were free cash flow positive. See, this is interesting, guys. Yeah, look at that. It's really interesting. So look at the free cash flow here. Their free cash flow was in 2022 and 2023. Look at that. That's $2 billion. That looks pretty sexy if you ask me. $2 billion. But look at it, though. It became negative. It's negative $620 million. That's $500 million. I don't like something erratic. I want it to be consistent, right? And remember, so it used to have a double dragon. But the problem is even when it had a double dragon, the net income still negative. In fact, 2022, that 2022 was negative $1.3 billion. That's really bad. Okay, but still, the free cash flow is looking sexy. So if this did become a profitable business, there could be a lot of gas in the tank. Okay, let's see what's going on here. Okay, so we kind of did this analysis. Now let's go ahead and do our enhanced AI analysis. For 2024, sadly, operating margins decreased. Operating cash flow decreased. There was a sign flip, so it became negative OCF. CapEx spending decreased. So they're trying to reduce their cost. CapEx is right here. They went from negative 37 to negative 25, so they're trying. Free cash flow sadly decreased by negative 126%. So let's go ahead now, use our AI, and let's take all this data that we have and let's synthesize strategic financial intelligence. And what this basically does is it basically collects and culminates all this data and gives it to me in insights, just so I can make sure I did not I'm not missing anything. So yeah, so I'm kind of running through all these comments here. It makes sense. They sold off their inventory, which is why you see that. Okay, so it's probably kind of a one-time free cash flow. Not something that sadly will be consistent. Um, Again, I like to look for consistency, but then by the time you look for consistency, then things get a stock price may leave us. So here's the strategic financial intelligence. Let me zoom in a little bit. Oh, hello. Sorry, I zoomed in the wrong screen. Mhm. So we can read it a little better. So this is our own AI. It goes through all the data and it doesn't hallucinate, and it gives you some recommendations. So we'll go ahead and do this again. This is not your typical YouTube channel. We don't really, do the whole hype. It's just straight up analysis, and I just little by little I get to know more about the company. All right. So final action: maintain a neutral hold stance unless concrete signs of a turnaround emerge. So I don't see a turnaround just yet. Open remains a high risk investment with speculative potential, while cost controls and revenue stabilization are positive. Consistent profitability and cash flow generation are needed to justify a sustained stock price recovery. Investors should monitor. Okay, yeah. So that's what I see here. So let's go ahead and let's see kind of what's going on here. Revenue performance, volatility with recent decline. So we have positive growth. Revenue surged 711 to 15 bill. So definitely a lot of good revenue. There is some recovery signs. Quarterly revenue rebounded. Okay. Negative, sharp decline. Okay. We got some revenue drop. Quarterly weakness. So gross margins fluctuates. Yeah. Extreme swings, man. You get from -5 to +2 because they sold off inventory. So it reflects erratic working capital management. A negative trend, OCF turned negative, raising liquidity concerns. 2023 was positive, but then now it's negative with renewed cash burn. Yeah, so there's that. Let's go ahead now, take a look at the quarterly real quick, and let's analyze the quarterly. So based off of the quarterly, I am seeing the quarterly losses be a lot better. If you look at Q1 for the free cash flow of 2023 and compare it to Q1 here, we are seeing dramatic increase. We are seeing a dramatic improvement. The thing is, what I would like to see is more of this green positive free cash flow. What I would like to see is multiple quarters of positive free cash flow and even net income, but positive free cash flow before I want to step in, right? Again, I'm not a holder of Opendoor, but I want to see more of this. They are trying, but let's go deeper. So this is our tri-statement financial insight engine. Let's go ahead and look at that. So this is open right here. Let's go ahead and analyze this and see what's going on. We have the income statement, balance sheet, and cash flow. So we already talked about revenue. That's really, what's going on here. So gross profit has been trending downwards. 730, 667, 487, 433. So their gross profit has been going down. Okay. Operating expenses have peaked at 2022, dropped down to 656, but unfortunately in 2024 they went up 753. So their expenses are going up from last year's. Operating income went from last year's negative 362 million to negative 320 million. So it's slight improvement in operating income, but again, it's still negative. Let's see. Net income obviously is becoming, it went from negative 275 to negative 392, so more unprofitable. Okay, so now let's go ahead and look at the balance sheet real quick. Here's the cash and cash equivalents. So in 2020, they had about 1.4 billion, 2021 1.7 billion, and then 2022 they had 1.1 billion. 2023 they had $999 million, and then 2024 they had 671 million of cash. So this is cash and cash equivalents. Well, first off, also look at this. Assets, they have about 3 billion of assets, 3.1 billion of assets, and 2.4 billion of liabilities. So at least from that perspective, they have more assets and liabilities. So there's that. It's not like AMC where there's more liabilities and assets, but their assets did go down from 3.5 billion to 3.1 billion. And then their liabilities, though, at least went down to 2.6 to 2.4. Probably a shift to pay off those. But we'll talk about that. Let's put cash and cash equivalents. So you can see their cash has been dwindling down, guys, right? So they have about $671 million in cash. So if you look at the market cap right now, it's currently trading at 551 million. So it's trading discounted to cash. The reason why it's trading discounted to cash, meaning that they have more cash than what they're worth right now. But the problem is they're burning a lot of money. So the market's anticipating they're going to burn more, and that's not going to be a turnaround. All right, let's see. Let's go further. Short-term investments have gone down. Total current assets are about 2.9 billion. Total current liabilities about 529. So that's pretty good, I would say. So they can satisfy their short-term debt obligations. But here's the problem: it depends, because it depends how illiquid are their property. The thing is that for inventory, they have about $2.1 billion of inventory, and that's most likely their houses that they own. In fact, free cash flow, if we recall here, goes back to here. Let's go back to annual. Free cash flow went from 2021 went from negative to positive, then to really positive in 2023. So I bet you their inventory dropped. You see how their inventory went from I can't speak. Their inventory went from 4.4 billion to 1.7 billion because they sold off, and we could kind of subtract it out. We could say 4460 minus 1775 is 2685, so $2.6 billion. And if you look at their free cash flow, it's around 2.3 billion. So again, that goes back to what you were saying regarding they sold off their inventory. That's why I said, I'm doing this analysis in real time, and as I'm analyzing the documents, it's telling me a story of how the company is being run, right? So again, I'm slowly collecting data. Again, I'm doing this live. I haven't done this before, so this is all I'm walking through it. And most people don't do this because this is 15% of the world is in the United States is financially literate, and you think about how many of them know how to read a financial statement. Though I would say that's kind of upsetting, but it is what it is. What else? Okay, long-term debt, they got about 1.8 bill. Okay, total liability. So they got more assets than liabilities. Not by a lot, but it's I would like to look at the delta, but I think they've done a good job kind of with this, decreasing it at least, but sadly the total assets have gone down with it too, which makes sense. Let's see, what else do we need to do? Yeah, this is another one. Look at total equity. Total equity went from 2.2 billion, 1 billion, 967 million to 713 million, guys. So obviously, that's why it's trading at around 500 million. They keep going down. Debt is going down, so that's good. Net debt, though, spiked up a little bit here. Okay, let's go to cash flow statement. Just analyzing. We already talked about free cash flow. Still analyzing. Yeah, so this is a good one to talk about. So look at the cash at the beginning of the period and cash at the end of the period. Let's actually graph that. Cash at the beginning, cash at the end. Let's actually upgrade the graph here. So look at this. So this is how I like to look at a company. So the problem is, look at the cash at the beginning. let's start at 2021. They went from 1.5 billion to 2.5 billion. But then in 2022, they went from 2.5 billion to 1.7 billion. Then in 2023, they started the year off with 1.7 billion and they ended with 1.5 billion. And then look at 2024. They started from 1.5 billion and ended with 763 million. I mean, 2024 was a disaster. I mean, they pretty much dropped the cash flow in half, right? And that's literally a 50% drop in cash. Sorry, not cash flow, cash and how much cash they have. So that makes sense. If you look at the stock price, I mean, it's literally, I mean, holy shit. I mean, this thing's literally dropped in half, 62%, right? Because, you know, their cash is dropping. So there's obviously, you know, depending on how liquid they're able to sell the homes, you know, are they able to figure this out, right? So let me give you an example of how a company should look like. Okay, let's give an example of how how Apple looks like. I think Apple's a standard company everyone knows, and perhaps you're watching this from an iPhone. So let's just take a look. So let's unselect this and let's look at cash at the beginning, cash at the end. Look at how in Apple, cash in the beginning and cash it historically is either the same in net, but it's usually not below. I mean, here it is. You're starting to see below, and that's potentially some investments. Let's take a look at another company. Let's look at Tesla. You see how it's not asymmetrically to the downside. Let's look at what's another company? I mean, that everyone knows about. I'm trying to think. Microsoft. Just, these are big companies. People know about them, right? Let's see. Cash at the beginning versus cash at the end. You see how Microsoft? Well, this one's different. Look at this. 2023, they had about 1.3. They had about 13 billion, and then now they had 34 billion. Oh, holy crap! Look at that. So cash. Oh man. So in 2023, they had about, again, this is 13,931 million, which is $13 billion, right? So in 2023, Microsoft went from 13 billion of cash to 34 billion of cash. Okay. And then they went from 34 billion back to 18, but still higher than the before. And that's most likely investments in their AI. That's when they started doing investments. And I'm sure you can backtrack and take a look at Microsoft's CapEx, which is the property, plants, and equipment. And you can see that it probably, you see right here in 2024, it went from negative 28 billion to negative 44 billion. Why? Because most likely they're investing in AI, right? So you can see how it kind of tells you a story. And I'm sure if you look at 2023, I'm sure Microsoft took off. So let's take a look at Microsoft in 2023. I'm sure if you look at Microsoft, look at that. Literally just blew up, right? Blew up over, it went from 239 to 400. That's why it's so important to understand how to read these statements. Okay, so again, that's why fundamental analysis is important. Now let's look at Clover. I always talk about Clover, right? Now this is, you can see kind of what I'm talking about. So now let's look at Clover. Why am I bullish on Clover? You can watch the videos, but you can see this was a share dilution. Then they invested. But then look at this. For the first time ever, they went from 176 million of cash at the beginning to 194. They're going up. Versus if you look at Opendoor, I mispressed it. If you look at Opendoor, Opendoor's doing something different. Opendoor is starting with more cash at the beginning of the year and ending off with less cash. So you can see how that's not good. Okay, so now that we have that, let's go ahead and do enhanced AI analysis and let's see what's going on. This is the enhanced AI analysis. Let's go back to 2024 and let's kind of figure things out. So revenue's gone down, cost of revenue's gone down, research and development's gone down, interest rates gone down. That's good. Operating income increased, which is good. Operating income ratio went down. Not good, not good. Cash equivalents went down by 32%. Property, plants, and equipment went down, which is good. Intangible assets, non-accounts payable, total. So other current liabilities went up. Total current liabilities went up. So that's not good. Inventory slowly going down, not by a lot. Sign flip. Cash at the end of the period dropped 50%. Look at that, which is why the stock dropped. Which is why the stock dropped 50%. Right. Operating cash flow flipped to the negative. So over, I mean, I'm not really seeing a turnaround right now. Right. I know this sounds terrible, but I'm not really seeing a turnaround. Let's go ahead and generate insights, and let's look at the comment section real quick. Oh, hell yeah, hell yeah. What's going on? All right, guys. So let's let it generate insights. And then after this, we're going to flip to, in fact, you know what I'm going to do? Let it analyze. And I'm just going to go ahead and go here. And I'm just going to let it, it's going to be on the computer and on my right screen. And it's going to type it out. And once it's done typing, I will bring it here. In the meantime, let's go ahead and open up our quantum charts. Let's open up the quantum realm. And then from this, we're going to look at institutional ownership. Well, first off, what's the analyst price target? So $1.75. Interesting. Analyst estimates. Well, actually, before we even do that, let's go to institutional ownership. Okay. Let's let's do 25 years. Here, give me a moment. Let's go here. Let's go here. Let's go here. Let's go open. Institutional ownership. Let's do 25 years. So investor holdings. So this is the simple moving average. Investor holdings, they've been below the average. So they've been actually selling. So a lot of institutions are selling now. You can see institutions are dumping. Number of 13F shares. The number of 13F shares are dwindling. So they're selling off. From the peak of 2021, they had about 470 million shares. Now they're at 376 million. So they're sold off. I see that the thing is typing. So we'll just hold off an institutional analysis for a sec. And let's go ahead and look at our, again, everything here is data driven. Okay. Okay, let's see what's going on here. It's still typing up. Just let it sit here. All right. So open is a high-risk speculative bet. The stock may appeal only to turnaround investors if management demonstrates sustainable cost control and revenue stabilization. Near-term downside risk dominate, but any positive EBITDA inflection could send the stock sky high, right? So let's see. So gross profit margins consistently weak, ranging from 4% to 9%. Okay. All right. Let me see here. I'm going to zoom in a little bit so you guys can read too. Annual trends, quarterly trends. Yeah. It was an operating disaster. Yeah. So cut costs, provided short-term. Just reading here. So low margins, industry laggard. So you got 8%, pretty low margins. Yeah, these margins are so low, guys. I mean, 8%. That's such low margins. I mean, like any That's why they're not doing well. Any macro event, obviously, they're gunning for decreasing in interest rates, two rates of increases, hopefully this year, and that could ultimately help people start moving around. There's been persistent losses, artificial improvement, liability cuts, right? So, yeah, and this was high because they were selling off that. Again, trying to sell off those assets. Let's see here. Cash burn. So again, bear case, continued losses and liquidity crunch could lead to bankruptcy or fire sale valuation. Bull case, if revenue stabilizes at 5 billion, I think they need about 3 billion per quarter, honestly. EBITDA could turn positive, supporting a distressed equity play. Debt reduction, yeah. All right, so there it is. So now we talked about this. So now let's go ahead and talk about this one here. Okay. So let's go back. So we're seeing a downtrend, and I don't see a breakout to the simple moving average side. So it's still downtrending on investor holdings. Total invested, obviously, it's gone down with the stock, and I don't really see institutions come back online. Ownership percent, it's currently at around 53%. It's been downtrending as institutions have been selling. Number of new positions, I don't see any active new positions that are above the normal simple moving average. So that's about 41 new positions that are active. But historically, if you look at the trend, it's still below the trend. I don't see a spike and new ownership, right? Increased positions. The number of increased positions have been going down. They're still increasing, but they're not increasing at a rate that would suggest a turnaround in the business cycle. Closed positions. Closed positions have broken out the historic norms, and they're about to increase even more now and break out. So people are closing their positions. Reducing positions. A lot of people are actually reducing their positions now. It's above the simple moving average line, meaning that's above trend. So people are reducing their positions. Okay. Okay, let's look at the total calls versus puts. So if you look at the put to call ratio, yeah. So there's high number levels of puts rather than calls. That's about 1.5. So people are shorting the stock. Calls, there's about 2.8 million in calls, and in puts, there's about 4.5 million in puts. So there are more puts than there are calls as institutions are bearish. Okay. So let me score it. If we score it, we have a bullish score of 3 and a bearish score of 6, overall bearish. Okay. So now let's go ahead, and I'm looking at now let me go ahead and just give me give me a moment. One moment, guys. One moment. I'm trying to. Okay, this is our beta test. I was not gonna fire this one up, but let's go ahead and do that. This still hasn't been created yet. It's still beta, but let's go ahead and see what it says for open. All right. So let's push against here. So Vanguard has been decreased a little bit. BlackRock has increased their positioning. T. Rowe Price Investments have increased their positioning. Renaissance has decreased their positioning. So you still have some big holders online. Again, so this is all part of the stock terminal, so we could see how many big boys are in here. Morgan Stanley decreased their positioning. Charles Schwab increasing. Okay. Give me a moment. One moment. So we have this. Okay. So now let's go ahead and open up the transcripts. Open. And then they don't have a Q1, right? No, they have a Q4. So this is the Q4. Let's go ahead now and generate insights and use the AI analysis to generate insights to see what they're saying on the quarterly report for the last quarter. Yeah, so BlackRock decreased. However, BlackRock increased, Renaissance decreased, but they still own a lot of shares. Okay, let's see what's going on here. So you're saying Goldman increased about 27 mil, 2 point. Yeah, you guys see it right here, right there. Goldman Sachs increased. Isn't this cool though? It's all part of the stock terminal. There it is, Opendoor. So now let's see what's going on here with its report, and let's see what they are saying. This is directly from the earnings call, so let's see what it says. Let's see here. Yeah, I mean, here's like for example, here's BlackRock, and here's Renaissance, and here's Fintel. So I'm just checking here. So Fintel says BlackRock has 52.7 mil. We have the same number. And then for Renaissance is around 17 mil. And then we have 17 mil with a decrease. Yeah, so it's the data looks pretty good to me, right? All right. So based off of what I'm saying, Sandeep, I'm gonna put you on right now. Let me just let this thing. Oh God, it's still typing. But you see where I'm saying, right? From all this data, I got to do intrinsic value. I just remembered. Okay, hold on. Let me read this. Let's see. Yeah, you see. So let's see what's going on. Opendoor's focus on unit economics and cost control positions its what are near-term challenges, success, hinges on executing product diversification, leveraging sector efficiencies, and capitalizing on eventual macro recovery. Investors should monitor contribution margin trends, inventory turnover, and debt management for signs of sustained progress. So as of right now, they're just gonna have to continue selling these houses at a potential loss to offset any types of issues they may have. They may do a reverse stock split. but I think the macro conditions are recovering based off what I said in the beginning of the video. I think they are leveraging an eventual capitalization of an eventual macro turnaround. So their business is sadly has to deal with macro, which the cool thing about Clover is it doesn't really have to deal with macro. It's nice but they hinges on the interest rates cut. But let's see what's going on here. let's read the rest.
Opendoor Technologies, comprehensive financial analysis report. Executive summary: Opendoor Technologies demonstrated disciplined execution in challenging macro environment, achieving notable improvements in contribution margins and cost efficiency. However, persistent headwinds in the housing market, including elevated interest rates and sluggish demand, continue to pressure near-term growth. The company's strategic focus on optimizing unit economics, expanding alternative revenue streams, and maintaining liquidity positions for long-term resilience.
Yeah, so a lot of elevated interest rates and the sluggish demand has really been a thorn in Opendoor.
Key positives: 1. Improved financial metrics, contribution margin expansion, achieved 4.7% contribution margin for FY 2024, a significant improvement from negative 3.7% in 2023. Reduced losses, adjusted EBITDA loss narrowed to $142 million versus $627 million in 2023, driven by cost discipline, high margin acquisitions.
Ooh, high margin acquisitions. What kind of?
Strong liquidity, maintained $1.18 in total capital, including $579 million in unrestricted cash, with extended debt maturities providing runway.
So the question is, how long do they have a runway for? And I think that runway is sufficient for a macro turnaround event to happen.
Cost optimization, executed $85 million in cost savings via workforce reductions and operational streamlining, inventory management, improved pricing segmentation, and dynamic spread adjustments enhance conversion rates despite wider spreads. 3. Strategic growth initiatives, diversify offerings, expansion of list with Opendoor and Marketplace now in Charlotte Raleigh diversifies. Revenue beyond iBuying, lead monetization, leveraging high intent seller traffic for agent referrals creates capital light revenue potential.
So there could be a leveraging high intent seller traffic for agent referrals, which could create a capital light revenue potential. So these are the negative. Let's look at the negatives.
Key negatives: 1. Macro headwinds persist. Slower housing market. Clearance rates down 25% year. Active listings up 20%. And delistings at decade highs. Signal weak demand. Interest.
Yeah, so the clearance rates are down 25%. Active listings are up 20%. Delistings at decade highs. Signal weak demand. I mean, usually the average house now that Opendoor has been saying is around 120 days. Oh, here it is. Inventory. Look.
Interest rate sensitivity. Persistent mortgage rate lock affects present seller participation and buyer affordability. 2.
You see, there's a mortgage rate lock because of 2020 low interest rates. So a lot of people don't want to move, so they're locked into their homes. Likewise, aging inventory. 46% of homes had greater than 120 days on the market. So this basically pressures margins. I hope you're reading this with me because I'm not reading all of it. This is really good information. So our system and our stock terminal, what it does is it takes in the earnings and it essentially analyzes it for you, right? That's all it is. Let's see.
Seasonal pressure, 0-1 contribution margin guidance, 4 to 4.7%, remains below target, 5 to 7% due to older inventory. 3. Revenue decline. FY 2025 revenue fell to $5.2 billion versus $5.9 billion in 2023, reflecting lower starting inventory and cautious acquisition.
Okay, let's see what's going on here.
Risk analysis. 1. Market risks. Prolonged housing down. Further rate hikes or economic weakness could extend recovery timelines. Spread volatility. Wider spreads may reduce conversion of competitors undercut pricing. 2. Operational risks. Execution of cost cuts. Failure to sustain efficiency gains could delay profitability. Tech-driven disruption. Rivals may replicate Opendoor's pricing algorithms or customer experience. 3. Liquidity risks. Debt maturities. Convertible notes due in 2026 require refinancing or capital raises if DDI TDA remains negative. Opportunities and emerging trends. 1.
So this is the big one here. Debt maturities. Convertible notes are due in 2026. But I think by then refinancing, the interest rates will be a lot lower than where they are now.
Opportunities and emerging trends. 1. Market share gains. Strategic acquisitions. Targeting 10% plus. YOY acquisition growth. X deals in a fragmented market. Geographic expansion. Selective entry into underserved markets with higher liquidity potential. 2. Product innovation. Marketplace growth. Off. MLS listings appeal to sellers hesitant about traditional exposure. Hybrid models. Lending iBuying with agent partnerships to capture more of the transaction funnel. 3. Macro recovery. Rate cuts in 2025 to 2026. Potential Fed easing to unlock seller mobility and improve affordability. Strategic recommendation. So rate cuts in 2025 and 2026. Potential Fed easing could unlock seller mobility and improve affordability. So I think that's what a lot of Renaissance is looking at. It is near book value now. And let's see. Strategic recommendations. 1. Margin optimization. Dynamic pricing. Further refine algorithms to balance spreads and conversion, especially in slow moving segments, e.g. Florida condos. Inventory turnover. Accelerate sales of aging inventory via targeted price adjustments or bulk dispositions. 2. Revenue diversification. Scale marketplace. Expand to 2-3 new markets annually, emphasizing 9-10 seller segments. Agent network monetization. Formalize referral programs to capture value from out of buy box leads. 3. Cost discipline. Variable cost alignment. So scale market. Expand to 2 to 3 markets. New annual. Okay. I see. Agent network monetization. Formalize referral programs to capture value from out of buy box leads. 3. Cost discipline. Variable cost alignment. Time marketing spend to seasonal demand, e.g. focus on 01/04. Tech automation, reduce per transaction overhead via algorithm pricing and underwriting. 4. Balance sheet preparedness, debt management, preemptive refinance 2026 conference if rates decline, capital-light models, prioritize partnerships. So that's what they want, debt management. So they want to refinance in 2026 if rates decline. They're trying to look at capital-light models. Capital-light models, prioritize partnerships, e.g. brokerages, lenders, to reduce inventory risk. Future outlook, base case 12,250 2026. Modest growth, revenue stabilizes at $5.58 range with 5 to 7% contribution margins. Break-even path, adjusted EBITDA approaches break-even by late 2025 if macro stabilizes. So essentially, break even potentially could be 2026. Interesting. Housing recovery. Rate cuts for transaction volumes, enabling 15-20% acquisition growth and 8% plus margins. Semicolon. Marketplace scale. Off. MLS listings contribute 10 to 15% revenue by 2027.
Okay, good. All right, so there's that. So there's our earnings terminal. What else do I need to do? This is a live, guys. There's like there's no outline here. I'm just trying to. The next thing I want to do is look at analyst estimates. Where is that? Oh yeah. It's on here. Let me exit the full screen. No, it's not. Let me go to home. Again, this is our lifetime access, so you can take advantage. We do have a sale coupon code SAS for folks that are interested in wanting to have data-driven approaches and understanding how to invest. The educational side. Here's the SAS coupon code. Take advantage. $1,200 off. Let me see. What else do I need to do? Analyst estimates. So let's go ahead and zoom out a little bit. Let's open up Opendoor. And let's. Oh, what else do I need? Let's analyst. There it is. Okay. So this is going to be good. I want to see kind of where revenue here. So they're expecting. Interesting. Interesting. Hold on, guys. Let me figure this out. Let me see. Revenue's been going down, right? See how it's been going down? What Wall Street's predicting is and again, Wall Street owns more than 50%, so they own about 58%, right? So, and again, this is a simple moving average, right? And it's a pretty good one too. 2026, they think by 2026, Opendoor is going to increase the revenue to $8.4 billion. And as you can see right now, it's $5 billion. Where it's at now, $5 billion. So next year, 5.4. So, okay. So what I'm basically seeing right now. Oh, okay, Sing. I'm so sorry. Just what one more moment. Can you tell I'm getting closer and closer to the I'm getting closer and closer. Again, I'm the more data I get, again, this is why data driven is important. The more data I get, the more I'm starting to get the picture. Okay. So in 2026, it's very interesting. 2026, Wall Street's expecting them to go up to $8.4 billion, right? So what's happening in 2026? Well, interest rates are most likely going to go down. So if interest rates go down, they're able to refinance their debt and they're able to basically get more revenue. And I think based off of my calculations, they need about $3 billion per quarter based off of today's valuations to be profitable. So 3 times 4 is about $12 billion. So they're headed there. And I honestly think that once this was revised upwards, I think they may even get to the 12 billion sooner than later. Interesting, it's low here. Okay, let's see what else. Even on the average revenue, 2026 seems like a breakout of the normal. Okay, let's continue. EBITDA, they're about to break a new generational path out of EBITDA. Now let's look at net income. So they're still expecting it to be unprofitable for the next 4 years, which makes sense. I don't know why they really are. They're expecting it to be unprofitable this long. It's kind of weird. Lot of analysts, 6 analysts in 2026. Okay. Okay. All right. Now let me go ahead and pull up the intrinsic value. Well, actually, wait. Let's look at the sentiment analysis for a sec. So let's look at the past 3 months, past 6 months, past year. Again, this is our sentiment machine. Let's run a machine analysis right now. So it's mildly bearish, no shit. So they were really bearish here in February 27. What was the stock price February 27? Yeah. Starts dropping low. So it gave you a hint. It pretty much said get the hell out. Pretty much said get the hell out. So let's analyze this for a sec. So then November 7th, 2024 was bad. Let's see. Yeah. So it warned you and the stock price dropped, right? And then it spiked up. And then the 25th, it spiked up and we had a big bounce, 46%. So if we are truly about to bounce right now, and it may go up another 40%, but it depends based off of sentiment. I'm not seeing any business turnaround yet. It's all driven by macro. Okay, so we got that. Now let's let market sentiment intelligence. So again, look at PLTR. I'll give you an example of how this works. You run the analysis, smart money became bullish, stock went up from like $10 to $100. If you look at Clove, same thing. They just became bullish and the stock price is going to start rising. Let's look at Open. Again, this is smart money, dumb money. So they've been back and forth. So that's why they were bearish now. And the stock is dropping. So I'm pretty much waiting for smart money and dumb money to switch now. So smart money can lead dumb money. So I'm waiting for that switch. So the switch is not there yet. Okay. So as of now, I'm not really too happy with this. Let's look at the price target software. Let's do Open, but this time we gotta do a couple of things here. So how much are they growing now? Well, we could look at let's look at, because we can't get this wrong. So we'll do the average. So what are we at right now? 5153. 5153. 2024. Let's look at 2026. They're expecting to be at 6267. 6267. That's about a 10.27% growth rate. $10.27. Okay. Okay, good. And then for free cash flow, again, let's look at quarterly and let's see kind of where we're at with free cash flow. And I don't want to do the free cash flow they sold. Okay, so here's the free cash flow. Let's see, 1377. Let's see, 56 divided by 1377. So that's about 0.04. So about 4% goes to free cash flow. Okay, that's fine. So we go back to the original revenue here. And let's say 5 billion
5,154.
multiplied by 4%. That's about 206 of free cash flow. Let's go ahead and calculate the price target. There it is. So based off of what I'm looking at right now, if Opendoor was able to translate 4% of the revenue to go to free cash flow, and they were able to grow at 10.27%, the stock can theoretically go anywhere between $2.15 to $6.56. Obviously, if they increase the number of free cash flow and revenue growth rate, the stock price could get higher. But here's the problem. And here's the problem that I have. Okay. So, as you've seen, it's been an hour, and I pretty much have taken all this data. I've absorbed it, I've internalized it, and this is kind of where I'm at right now. So, when is the next earnings report for Open, and are they going to burn more cash? Based off of what I'm seeing now, I believe they are going to burn more cash. If the Federal Reserve doesn't cut interest rates in May, so it's May 6th. Excellent. Okay. So we'll talk about this. Good. So same time as Clover. Wow. Hopefully once before and after. Maybe we can do both, right? So, okay. Because I'm curious. So what I'm understanding right now is, now, Singh, I'm going to let you on right now. I'm going to give my kind of statement address, and then but if you can help me answer this question also, do you expect a business turnaround to happen this quarter or in the next 4 quarters? Personally, I think not. Right? I think that the next quarter they're going to burn more cash, because I'm not seeing anything to where, because what's changed in the macro environment? What's changed? Now, I think what Opendoor CEO was banking on was that interest rates will be cut in May, which is what we were supposed to do. But with the tariff war and all the bullshit that pretty much pushed Feds, because of inflation fears and all that, it pushed the Federal Reserve to postpone the interest rate cut later. So because it's pushed later now, then I don't think there's going to be a business turnaround until these interest rates start getting cut. And then ultimately, then we would get into a position where, people were able to, refinance, people are able to sell their homes. But what I'm seeing right now is, because there is currently no macro change, I think the thesis is still bearish, which I can take advantage of, because if this is great, because if they keep burning more cash, then their cash and cash equivalents will keep going down. Right? And as their cash and cash equivalents decrease and go down, it'll cause the market cap to go down. And depending how long it'll take to go down, it might give an opportunity for a reverse stock split. So the people that are holding it right now sadly get hurt. This is why fundamental analysis is important. But it allow for new buyers to step in, because then their prices would go down even more, almost like AMC. But AMC is way worse. At least this thing has assets over liabilities. So, but here's the problem we have to battle. The market's slow right now because of tariffs. So this could be a market bottom for Opendoor, for it to retrace back to its pre-tariff pricing, which was, God, let me see. Give me a moment. Yeah, $1.49. As of right now, it's literally trading below book value. And because it's trading below book value, I think it's good to look at. But what I'm doing is, what I'm thinking is, I'm scared, because if I invest now and then they're going to burn more cash, well then, and their answer is, well, we're just waiting for the macro events to change. Well, I don't have to be an investor right now. I can just wait until the macro events are about to change and then go ahead and step in. And I think the stock is so dead now that a lot of retail investors don't know about it. So it's good to monitor. So things that I'm looking for is I'm going to wait until the macro events change, or they're about to change. I'm going to wait until because here's the problem. They're going to burn more cash. They're going to burn more cash until the macro events change. So why am I going to hold a stock that's burning cash waiting for the macro events to change? I can still wait and do nothing, watch them burn cash, wait till the macro events change or soon to be changed. And once they have a switch, I can step in. Maybe. Again, I'm thinking out loud. Okay. So that's all I have to say. Let me go ahead and how do I invite someone? That's the next problem I have to do. Okay. So let's talk for a good 15 minutes, 16, whatever, 15, whatever. We'll do something like this. So how do I do this? Oh, invite guest. There's a button. Copy. It's that easy. They made this really easy. Okay. Here is the link to stream to join this. I'm gonna see if I can DM it. Did you DM me on Twitter? Maybe I can DM it to you. I didn't see a DM. Can I DM you? Yeah, I can DM you. Let me DM you. Okay, I just DM'd you on Twitter. Oh, there you are. Okay. Let me see how this works. Hey, okay, good.
All right, good. Sorry, I'm not.
All right. All right. Can everybody hear him? Because I can hear him, but I don't know. Let me double check. Can anybody? Let me check my phone. Can anyone hear him? Can people hear?
Mic check 1 2.
Oh, good. Okay, they say yes. They say yes. All right.
How's it
good. Doing pretty good. Okay, so yeah. So sorry, it took me some time. I'm just trying to. I haven't looked at this company in a long time, so
I know, and brother, I swear to God, I got into this business. It's the same time I got into Clover. So Clover started with you, I stuck with you, right? And the same position now, same thing happened with Opendoor. So your first question that you had was macro. Will they burn cash? Yes. Okay, it's gonna happen, but the amount of cash they're gonna burn is gonna be far less than what the market is picking up on. Okay, I think where we were for Clover in 2023 is where we are for Opendoor 2025. I tell you why. So a few metrics you have to look at. I understand, we have to look at the gross, EBITDA, blah, 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 right? But Opendoor has a different type of metric that you have to pay attention to. So gross profit per home, contribution profit per home. Contribution profit is the metric that if they buy one house, the marketing, the holding, the maintenance, and everything, all the cost that is associated for them to sell that and make money, that's contribution profit. Then comes your fixed SG&A, the admin, and whatnot. Okay, so contribution profit is the main metric. Now let's go on forward to, okay, so what is market expecting, right? So we're gonna go Q1, right? The market, they're guiding for adjusted EBITDA loss of $40 to $50 million. What they have done in the previous past, they have always overshot the guidance. They always bump their guidance low and they come up on top. So I'm expecting adjusted EBITDA of around 25-30 based on the model if they sell 1,100 homes per month. So there's a lot of things we have to see, right? So basically how they make business. So if you look at 21, 22, 23, you have to understand how many houses were they selling per month and what they have done. I know the management is kind of slow in turning the ship around, but it takes time because yes, it's a tech play, but it's a logistic play. Just like Amazon, you have to build logistics. You buy a house, you send vendors in, you have to monitor the vendors, get the product ready, and get it out. Now, also we have headwinds from the external macro events, right? We cannot do anything about that.
Yeah.
So what they have done in past 2 years is they've reduced their cost. They've spun off another company, Mainstay, out. So operation 80 million they're going to save there this year. And then all they have to do is just increase their growth by 20%, okay? Which in Q2 and Q3 is their main selling season. So that's the spring and the summer season. Q1, Q4 is acquisition, but getting ready for Q2, Q3. So those are the quarters that we have to pay attention to. So I agree with all the analysis. I'll checkpoint on all of those. So right now, I just explained to you that this is what I'm expecting, and this is what we should pay attention to, which is I don't believe what happening with the stock price is another thing, right? And we've seen that with Clover. And just because we got in early, we held on to it, even though they were losing money. For you as an investor, yeah, sure, you can wait, but I think this is that time.
Just for people that are watching, what made me very bullish on Clover was they had two businesses. They had the ACO, which was unprofitable. It was like the MCR wouldn't change, but they had the Medicare Advantage, and that went from 101 MCR, 110 MCR down to 85, 80. So I was like, okay, this is definitely. They just got to cut that shit. They got to cut the ACO.
That shit. Absolutely. Absolutely. So guess what? So what the CEO did here was, she's like, okay, you have the list with the Opendoor, so a seller can go and list with them and just test out the market before go to MLS, capitalized business. Then they have a marketplace where you and me, buyer and sellers, just interact with each other, and they just collect the fees off the transaction rather than taking the houses on the inventory. Okay, these are two products similar to Counter Health, SaaS, Capital Light. That's what they're working on. They also have that going, and they're gonna grow that business this year, right? All they did last 2 years was focus on the core product, make that profitable, which they have, contribution per home. It's all about the scale, the growth. They can really, bro, get it, because if you think about a total overall market, there's 4.5 million homes that are being sold. If you look at the $350,000 to $500,000 range, they're only capturing 3% of it. Okay, as of now. So for them to get 50 beeps more is not a big issue. Okay, they were doing 2,500 homes per month. Now they're doing 1,000 to 1,100 a month. All they need to do is 1,300 per month to reach adjusted break even. You see what I'm saying? So
I do say, yeah.
Okay, so the point that I'm making here is, yes, we will lose money, not to 300, but I believe it's going to be around 80 to 120. Okay, they'll reduce it significantly, that's for sure. And maybe next year that we can go into a profitability, adjusted income profitability. But I do see Q2, Q3 as could be adjusted EBITDA profitability.
So you're thinking, it's okay. So let me pull up the chart here. So net income for 2024 was negative 392 million. So what do you think the negative net income would be?
120.
80 to 120. Okay. So
and you're sitting with $1.1 billion capital, which is 300 is sitting in the homes. You have pure cash of 650.
But the thing is, the book value now, it dropped a lot. It went from 1.47 to 1.01. So based off of this, what is your prediction for book value to be at now with that 80? You see what I'm saying? So like, what would be, because right now it's at $1.02.
Okay.
What would book value be?
If they give the 80 to 120 loss, where the I don't know the math.
I think it'll go down lower, right? I gotta calculate how much it'll go down.
Yeah, I haven't done that yet. Yeah,
and then if it goes down, let's say for example, this is not the right. This is not the book. This is not. I'm guessing. Let's say it dropped 50 pennies or 47 pennies from last year to. Let's say it drops 25 pennies. Just to make the math easy, the book value would go down to 75 cents. Okay,
sure.
And so then, what happens if we have another uncertainty event? If we have another uncertainty event, then it could go from 75 cents down to 50 cents. I
No,
think.
no, let's stop there. So
But
let's just talk about it.
reason why I think it dropped to 75 pennies though,
No,
it's because of the tariffs. I think because of just the whole market was down.
100%. So let's
Yeah.
double click on that, right? Let's double click on that. So you're saying tariffs. What would tariffs do? Tariffs will only make housing increase. So the existing inventory that they have, that they bought it last year, which they're selling this year, the house is like gonna go up, which is gonna translate into a house pricing appreciation. The contribution profit will even go further higher. All they have to do is a key point here. All they have to do is be careful with the spreads when they're buying. Okay. Now, what they have started doing Q4 2023 is that, if they know the area well and they can underwrite homes, they will lower the spread there because it's easy to buy and sell there. Okay. So that's how they get the volume. What they did earlier was they kept, okay, macro, we're scared.
Yeah.
Let's just lower the spreads and just stop only by underwrite homes that we're comfortable doing it. What they have done now is, let's just say there's one area, the housing market is strong. The areas are different in housing, so they come and they sell fast. So over there they'll lower the spreads and they'll optimize on that volume. And where they're not sure about selling, they'll widen the spread and they'll keep that margin of safety because they already learned the hard lesson in 2022. Right. So this is a very key point that they have pivoted into Q4 2023, that pricing optimization.
Yeah, I saw they got rid of a lot of their inventory. I saw that on the
pricing optimization is what I think. Now, no, let's just pivot. That's just the business and the macro and what we discussed, right? Now,
let me show you very quickly. So we talked about Clover. Let me just really quickly here. So Clove, let's open up Clove. Oh, you can't see it. Let me see.
No, that's fine. I have my Bloomberg.
I can show you here. Look. You see right here. Look at the screen.
Yeah, I got it. Yeah.
You see it? Yeah. Oh, I can do it. I didn't know I could. Yeah.
We learn as we go.
Wow, this is very nice. Okay. Whoa. Okay. I like this. Okay. So, all right. So here's the book value. Okay. Look at Clover. So let me zoom in because sometimes it's hard to see on the phones. So here's the book value in 2020. So 2021, the book value was $1.15. 2022, the book value dropped to 73 pennies. 2023, it dropped to 59 pennies.
That's what you were talking about, right?
Exactly. And then in 2024, it went up to 70 pennies. You see that? So then there was reverse on the book value. You see how the book value reversed? Now let's open it up and go deeper and look at the quarterly book values. You could see, 73 cents, 67 cents, 69 cents, 67 cents, 59 cents. That's what I was talking about. And I'm thinking that it might happen to Opendoor. So 60, and all of a sudden it started going up.
Annual again?
Huh?
Go back to the annual. Quarterly.
Of course.
Yeah,
of course.
Okay.
Yeah, here's the annual. Let me highlight
that 73 to 59. That's what you're talking about, right? What
exactly.
I'm saying is, that is where we are. That 2023 is where we are now. Okay.
You think that this year the book value? No, I think this year book value would go down more.
Go down, but not to this extent because they managed it.
Okay, I see.
They have managed it.
Because check this out. If you look at
honestly, I could be wrong, but I'm also leaning towards adjusted EBITDA positive.
I mean, the thing is, analysts are not expecting profitability from the net income.
26, 27.
No, they're not expecting it. I watch. If you look at the here where the analysts are thinking. Let me it's a little zoomed out here. Let me exit. Let me refresh the page. Okay, good. Let's score it. No, we don't need to score it. Let's look at I went to the wrong one. Let me go analysts. Here, this one. Sorry. Here's the net, and this is the high. This is their high estimates. This is profitability above zero. They're not expecting them to be profitable. Again, I don't trust analysts, but
I was just about to say that, bro. We've been there with Clover and Open.
Right.
This is take it as a grain of salt, right?
But the thing is, here's the thing though. There is, like, for example, look at Clover. You look at Clover now and you look at analyst estimates and look at net income. Even for Clover, they're expecting at least, even with Clover, they're expecting profitability in 2028. And by the way, this terminal goes into, it's like a Bloomberg terminal. It
But
goes.
see, that's exactly proves our point, right? So 2028, we're gonna go to profitability 26, if not this year.
I from what I'm seeing in the data, it's not showing me. It's not. I'm not seeing it. I'm not. I could be wrong.
Oh, no,
2026.
not open. I was talking about Clover. Like,
Oh,
you know how
Clover. Yeah.
there's-
Oh,
yeah,
I
man.
think,
You know,
oh,
like, yeah,
100%. I think 2026 will be profitable based
Yeah.
off of the CFO Peter.
Yeah,
but
exactly.
but most definitely 2027. So, but here's the thing. So especially after the effective rate of 9% increase, that's for Clover. So I'm sorry for people that are watching because like I'm getting confused between the two. So okay. So the book value though for Open went from $1.73 to $1.47 to $1.02. Now, obviously, now it's trading below book value. For Clover, it traded right at book value. It traded right at 60 cents. Right now, Opendoor is trading below book value. So potentially, the market is pricing.
77, yeah.
I think the market's pricing that the book value will be 75 pennies by the end of the year. I think that's what they're pricing. My only fear, so this could potentially be the bottom for Opendoor, right?
Mhm.
My fear is that what happens if a year from now, yes, we get the interest rates cuts, Opendoor finally is able to change things. My fear is what happens if they still can't raise book value? And then, okay, fine. Let's say it stays at 75 pennies, and let's say they do stabilize. What happens if there's another uncertainty event? Then potentially it could go down to 65, 60 cents, right? It could go down. But the problem is if true book value goes to 75 cents, then what's going to end up happening is they're going to have at least, how many days do you have to be above under $1?
It's like 30 days.
30 days. So based off of this, I don't see any interest rate cuts in the next at
Well,
least.
that's not going to change anything because we got the 2 interest rate cuts and the 10-year Treasury went up. So the mortgage rates are driven by the 10-year Treasury. So
No, I'm just saying the overall market for this play.
It's the 10-year Treasury. It's the 10-year Treasury.
So like for me, what I'm balancing right now is let me just kind of show us back here. What I'm in my head, what I'm balancing is, do I invest now or do I wait?
Oh, you can wait, right? If I was you, I wouldn't get in now. I'm already in, right? But what I'm saying is this is the same thing that has happened to us with Clover.
Yeah.
But like we went to 62, it didn't make any sense. I'm telling you, this does not make any sense because we're going with book value. All you're doing is you're eliminating the tech mode and the logistics.
Yeah. Oh, yeah.
Doing 6 billion. You're telling me you can do 15 billion worth. The correct comparison, Al, what I'll tell you to do is you look at Carvana.
Oh, yeah. No. Yeah. That's the argument. That's what we were saying. This is the argument. Yeah.
Oh, this is Carvana, but just minus that management, and then people are complaining about the management, right? You
never know. You never know. They could pull someone from Carvana and switch the whole thing up.
I'm telling you, that's one thing. Number 2, you have to understand.
I'm seeing Renaissance Technology buy more. I'm seeing a lot of this. There is something here,
bro. The biggest thing you have to look at is who co-founded this. Keith Rebbio from PayPal, Square, Stripe, Opendoor. Keith Rebbio is a prominent VC.
What? Also, another person who founded it actually went to Arizona.
And JD Ross.
I don't know him, but I know a friend of a friend. Yeah, so that's pretty
look at that, right? Yeah. Look at the cap table on the institution thing. Look at Anderson Horowitz. Personally has bought it, right? So
I see.
So so these are just the things to make me feel like, obviously, what do we know, right? All I know is
the institutions are still holding. Yeah, it's still up there. It is downtrending, 5%. But it's still downtrending. It's under the thing, but it could reverse. And the people that look at this now, again, how I became a multimillionaire is because I essentially was able to look at companies when no one wanted them, right? Right. That's when you make a lot make
That's what it is.
But you got to look at the turnaround because you got to be careful because what happens is if they don't turn around and they do a reverse stock split, and then you get you get retail panicking, and institutions love that. They'll drop it even more, right? But
I think what you're talking about right now is now. I think what you're saying now, this what you just said is
it's
now.
happening now. It's happening now. Okay,
No.
so that
It's not, bro. It's
that-
$500 million. You're telling me 500 million market cap for a $6 billion revenue. All they have to increase it by 10% their revenue, and then go to adjusted EBITDA profitability.
exactly.
Like,
Exactly. No. This makes sense. So okay. So yeah. So I'm monitoring this. We'll look at the earnings. I'll do even a deeper dive on it.
yeah, let's do that. I'll be more dressed up. I'll be in the office. So.
Oh, you look good, man. Yeah. And also, my camera is not. This is the webcam. I'm out of my studio, so I don't have my my stuff.
So no,
But
you should definitely watch us. So I'm very looking forward to May 6th, and
yeah,
I think it's a similar thing I've seen when Clover.
Is it before or after?
No, bro. It's the same fucking time. Oh, sorry.
Oh no, it's okay. It's okay. It's the same fucking time. Okay, it's the same. Yeah, it's the same time. So
it's the same
that's
time. So I get conflicted, but I'm not so worried about Clover anymore. So that's like my risk. So that's gonna if this doesn't work out, Clover will help me out, right? So I'm not so fussed about it.
Yeah,
right?
yeah.
What I'm saying is for you, brother, this is that because what happened in Clover 2024 May,
It's happening.
It adjusted EBITDA, they threw it down to 62, right? To get so the shorts can play their role and take it, and they can get out by 140, 150. They still make money, right? I think that similar process has happened. There's no reason for it to go to 77. There's no news.
I see.
There's no news. If you look at the March pending home sales, month over month went up 6%. Okay.
Yeah.
So
yeah.
you got Pulte at Fannie and Fat. He's streamlining the whole mortgage thing. So they all work. Okay. So higher level. Scott Bassett paying attention to the 10-year Treasury. Okay.
Yes,
that comes down because of the debt. If that comes down, the mortgage will come down. Okay. Then you get the volume going in. That's Q2, Q3. Tariffs are happening. It's only going to make the housing expensive. So the existing inventory will give you gain.
I see.
Okay.
No, I think
that's another way of looking at it. I'm saying there are a lot of other materials like people are focusing on interest rate. Yeah, that's a short end curve, but the mortgage rates don't get driven by that interest rate cuts. So that's how I'm looking at it. But I just wanted to come on here and share because I don't do this YouTube stuff, but I do watch you, and thank you for having me on.
No, yeah, of course. No, of course. So the thing about the channel is, I hope that you've seen the analysis that we do is not. This is not bullshit analysis. This is real analysis.
It's legit. It's legit.
And unfortunately, there's not a lot of people that know how to do this. And what was
you're not a CFA, right?
No. So actually, it's funny that you say that. So I actually wanted to become a chartered financial analyst.
I am.
Yeah. So for folks that don't know, chartered financial analyst is very difficult. It's like level 1, level 2, level 3.
Yeah,
and but it's funny. I have a lot of CFA friends, a lot. I just had a meeting with one in Scottsdale. It's really So I'm actually I'm self-taught. I taught the economics division and the MBA for finance and economics at Eller, which is where this founder of Opendoor went. I believe went to Eller. So that's really cool.
It's interesting. But the thing is, you already know the basics. I didn't know when I did it because I come from hotel management. So I did that to understand the market. I was trading. I was in the market, but I lost a lot. So I wanted to learn about it. And that's how I got into the CFA. Now I'm an analyst. So that's
I'm seeing the chat. By the way, sorry, I'm behind on the chat, guys. Someone is asking. So wait, so he's saying you're a CFA. So if you can, just for people that don't know, because describe the process. You might. There's some kids that watch this channel. Describe kind of because you can be inspiring them. Kind of what is a CFA? What's the process? Because it's very tough. Very hard. And then
so CFA is like a chartered financial analyst. It's a program, it's a designation that you get, which is top at the top in finance, right? So there's 3 levels. You start level 1, level 2, level 3. If I were to just highlight it, level 1 is once a year. It used to be once a year when I did it. Now it's twice a year. Level 2 once a year. Level 3 once a year. So the passing rate for level 1 is 38%. Level 2 would be it's lesser than that because that's where the filet mignon is, which is 28 to 30%. And level 3 is like 52%. So if you were to get into a program and let's just say you do pass it on the first go, you multiply these percentage, only 5 to 7% make it for the CFA, right? So I think it's in terms of the knowledge, if you really, like you said, fundamental analysis, you can give them your tool, the terminal, but they need to know where to look and what to ask. If just like in AI, if you don't know the questions to ask, you can't really do much about that.
So I tried to, because I'm trying to like figure it out, because I've been in academia for a long time. And so I was like, how do I bring them from 0 to hero when they go lifetime? And the way I did it was, okay, I'll have the educational platform, right? Lots of pages. It'll soon be converted to videos. So that'll at least give them the understanding of what it is. So then I have the terminal, which gives them 2.5 billion outputs, right? But here's the difference. Now there's a button. It's called Generate Insights. They don't have to ask the questions anymore.
Exactly.
It gives you the
but
insight.
But still, to that point, Al, even though they have that information, what do they do with it?
And that's where that's where we have. Yeah, this is why the YouTube channel, the Discord, talk about it. They need it. You have to talk. You have to massage it. It's like a big steak. That's not. You have to tenderize it, and you have to understand it, because you give a dumbass ChatGPT, what is he gonna do? He's gonna say, can you spell out boob? What's he gonna do, right?
What's that? What's that? Anyways, I gotta drop off here. All right.
Yeah, but this was good.
Chatting with you. Thank you so much for calling me over.
Of course, absolutely.
Thanks,
Perfect.
brother.
Sounds good. Of course, brother. God bless. Perfect. All right, guys. So, let's go ahead and let's go through the comment section, and then that's it. We'll roll it off. So wanted to say thanks. We got about 203 people watching on Twitter and about 56 on YouTube. But literally a lot. I just checked. It's crazy. It's a lot of people here. So let's go ahead and let's just let me just, I'm going through the here, let me show you if I can show you. Oh God. That's pretty insane, isn't it? That gives you headache. So I'm looking through your comment sections here. So let me just do that. That's a lot better than this. Okay, so let me see.
What do you think about Humana?
Humana? You're asking James Wright. I'm going to be doing a video about Humana. Let me see.
Daily show actual free cash flow burn for QTR is $20 million sign. Hard cash.
Hard cash. Okay, I'm an investor. There's another question. I'm an investor in both Opendoor and Clover. What happened to Opendoor? Almost similar to what happened to Clover. I'm optimistic about Opendoor and will follow Clover. Absolutely. So I'm looking right now at book value, and I'm like, okay, how I got to estimate the cash burn. It's just simple math, right? Just estimate the cash burn, seeing kind of where it's at from Q1, kind of figuring it out, and seeing honestly where they estimated at, and then seeing what book value could be, and then take a 25% margin of safety of that. And who knows? It may be 75 cents. It may be 75 cents, and this may be the bottom. I don't know, right? But or it could be the worst case scenario. Macro events deteriorate, inflation goes up, just worst of the worst. Feds don't cut interest rates, then they're going to have to do a reverse stock split. I mean, that is a possibility, and we have to talk about that, right? But I'm interested in this, because if it's about to turn around, and I'm seeing institutions that are well known buying the dip, interesting, right? Let's see. Let me look at this other comment here. Tariffs will make construction more material.
Construction materials more expensive, but Americans will stop buying because everything else food, unemployment will hit hard.
Well, that's what they're looking at. Then the feds will have to step in.
There will be more inventory and more supply than demand. House prices will go down.
Yeah. And then the exchange rate will be a lot higher.
I would make a macro offense to jump in, and I would like to see even stock valuation on open, and then later see if I jump in.
Yeah. So Pepe lifetime. Yeah. So Pepe's lifetime member. Love you a lot, brother. Thank you for your support in the platform. I mean, I've gained a lot of weight trying to build this damn thing. It's been hard, but I'll tell you, that makes sense. I know that for all the current Opendoor holders, we hate to be talking like this, because I'm sure you've lost money and you're like, what the hell? You know, these people talking about, we're hoping for a dilution so we can jump in. I know that sounds terrible. I'm almost trying to imagine myself putting myself in your shoes. But I'm just teaching you kind of how Wall Street's ruthless. Wall Street's nasty. They don't give a damn about you. And what I'm trying to do is I'm trying to create a platform that gives it to you raw. This all data. Everything we talked about here is all data. There's no there's not I feel. There's no I feel here. Right? If you want to feel, I don't want to say it's inappropriate, right? But Wall Street's not the place, right? Okay, so what stock do you guys talking about? Opendoor. By the way, JD Ross commented, guys. Who's JD Ross? JD Ross commented. Who's that? JD Ross. JD Ross. Where? I don't really see the comments. Sorry, there's a lot of comments here. I'm sorry, guys. I don't know. I'm sorry. My apologies to JD. I don't know who JD Ross is. I'm an academic, guys. I mean, I don't really know who's hip. If someone can explain to me who JD is. Whenever I think of JD, I think of Scrubs, right? His name is JD. Oh yeah, Dr. Patel's in the house. What? Tuya. Okay. Let's take a look at the Tuya. All right, we'll talk. We'll look into this China stock. You gotta be careful, China. Yeah. Hey, 3D machines. I'm flipping late. What's going on? 3D machines. Yeah, I'm so behind on the comments, guys. Yeah, I see no JD. Okay. And then shout out to Rick. Love you, Rick. Love you, Rick. All right. Let's see. I'm just going through all the comments here on your conversation. Cool. Oh wow. Yeah. Oh, cool. I didn't know. Yeah.
That's why I only nibbled a little and open. If they reverse split and drop more, I think, guys, when the big guys will come in.
Yeah, I mean, here, guys, listen. I know a lot of. It was really kind of cool. I know a lot of famous people. It's really cool. But I mean, we're all the same. It's not because you know a famous person you're any special. You do good work. You do something with passion and love. You're gonna attract other people that are passionate. But again, I still don't know who's JD. Sorry. Let me see.
That's why I only nibbled a little and open. If they reverse split and drop more, I think, guys, when the big guys will come in.
Good. Okay, I see that. Good.
If they stay below $1 for 30 days, then they get 90 to 180 days to come up with a plan to get back above $1. If they do like cloth and recover that split, will do a nice jump.
That makes sense. So then they get another 90 to 100 days to recover, right? They can get they do an extension. So I think they may and this may be another Clover play, right? Do you see it lower after ER? Well, here's the thing, Mirage. If they're burning cash, potentially, but the problem is the tariffs and the S&P was down 15%. So as the S&P recovers, I think Opendoor will recover. So the market's pretty hard hit. So it depends. This may be the future essence of book value. So it may stay at these levels. But could it drop more? It certainly could. I would have to take a look at it to see. I need to do more analysis, but we'll see. Right? I'm glad Al finally picked Opendoor. Yeah. So again, I'm not an investor yet. I'm not buying the stock. I'm waiting. I'm waiting for the earnings on May 6th, and I'm waiting for book value to go up a little lower and seeing how the market treats it. I'm comfortable buying at 150 if I have to. You know what I mean? Rather than losing money, right? So I'd rather buy a good business at a fair value than something that's not, right? Let's see. So I'm just waiting.
Data from ER will make that decision. No, wait to predict the future.
No way to predict the future. Exactly. So these are all people that are part of Lifetime, right? Yep, he's a CFA. Had earnings up 5% after hours. Wow, excellent. Oh yeah. We got to do a video. Man, so many videos you have to do. Because then did they report today, guys? Woo! Up 5%. Let's go. Good job. Oh, he's the founder. Oh, so he commented, the founder. No, so okay, guys. So let me be a little bit more honest with you guys. So Opendoor, it's actually pretty cool. Well, first, guys, first thing, if JD, if you are watching, JD, can I say something? You gotta this. I just put Opendoor and look at the reviews. I got 65 reviews, and they're like they're all negative. This company is located Tempe, owns multiple homes. Extraordinary greed. I mean, you're not in the money, you're not in the business to make these people happy, but you got to be careful. You know what I mean? People look at this review, so you got to do a whole. You got to see what's going on here, and you don't know if these are shorts too. I don't know. It's just I don't really trust people. But anyway, let me just kind of be a little bit more. So Eric Wu, he actually got his education at University of Arizona, and then if you look at me. I also got my education from U of A as well, right? So there certainly some connections here, right? Okay. Well, that's pretty cool. Hey, welcome, JD. It's awesome to have you here. I do more Clover Health. If you want, you can email me at al@alstocktrades.com. We could go ahead and talk about it. Obviously, we'll probably have to refrain from talking about future earnings and stocks relevant to cash flow or anything, because that could be a problem with the SEC. But yeah, I'm happy to talk about just the overall business model. That'd be cool. All right, guys. So that's all I have for you guys. This will conclude the live for Opendoor. We'll revisit this back when we have the earnings report for Open here, and we'll basically see kind of where things are at from that angle. For folks that are interested in our stock terminal, because we talked about it a lot, we have access to the most advanced stock terminal for retail investors on the market. It has AI. It just has everything you could think of. It's coupon code SAS, which is SAAS. You get $1,200 off. For all my American and Canadian companions, you also have access to Affirm. Thank you, Affirm, for sponsoring our platform. You're able to affirm this and have it's a one-time payment, lifetime access. And also thanks to PayPal as well for being able to affiliate itself with our company and regarding to financing options for folks that don't have the opportunity. Our platform is all about being able to find the next 10 baggers, being able to find undervalued companies, doing real intrinsic value calculations, and essentially having the same tooltips and data designs and financial data that the billionaires have on Wall Street. So it's definitely very excited, and that's all I have. I'm just going to read this last comment. Hey, how you doing? What's going on back in the house? Is Humana star ratings cut? Yeah, so we'll talk about Humana. We'll make a video on that. I think that'll be a very good video. I want it to be nice and long, so we'll talk about that. Primary care use of counterpart assistant associate. Oh, really? New article just released?
Primary care physician use of counterpart?
Every time I make a video, there's always something released about counterpart, and I don't really see it until after. So I'll look into it. All right, ladies and gentlemen, I love you all. God bless you all. And I'll see you probably in the next hour or two. Within that, we'll make another live and talk about Clover, okay? Or Humana. I got to figure it out. Maybe Humana will be tomorrow, okay? I'll see you all on the next one. God bless you all. Peace.